We're only a quarter of the way through 2024, but this year has already been a hell of a ride for crypto. With the chapter closed on Q1, it's time to look back at the pumps, the dumps, the memes, and Ponzi schemes that have brought us to where we are today. Well, earlier this month, one of the biggest crypto companies dropped a 50-page Q1 market report packed with charts, facts, and figures that tell a story of the year in crypto so far. We went through the report with a fine-tooth comb, and today we're going to break down some of its most important findings and tell you what it means for the crypto market. If you want to understand where we are in this current cycle and also make some educated guesses about where we may be headed next, this is a video that you don't want to miss. The report that we'll be summarizing today was published by CoinGecko. It begins with a note from its founders, the COO, Bobby Ong, and the CEO, TM Lee, who point out that CoinGecko turned 10 this month. And yes, that does mean 10 years. Honestly, lasting 10 months in this industry is a feat in itself. So, to create a piece of crypto market infrastructure that is not only still relevant, but vital an entire decade later is pretty amazing. Hats off and happy belated birthday to CoinGecko. Now, the report itself is broken down into 7 sections. The first is an overview of the market landscape, followed by a separate analysis of Bitcoin, Ethereum, Solana, DeFi, NFTs, and finally exchanges. As you'd expect from CoinGecko, each section is packed with interesting graphs and statistics. We can't cover all of them thoroughly here, so we do suggest that you look through the report yourself. We'll drop a link to it in the description. Instead, we'll break down our biggest takeaways from the report for you and explain why they matter. Let's get started. If you've been in crypto for more than 5 minutes, you'll know that it's BTC that leads the market. BTC's price action can be used as a shorthand to describe the state of crypto in general. For this reason, we're going to discuss the market landscape and Bitcoin analysis sections of CoinGecko's report in tandem. The first highlight shared by CoinGecko is about Bitcoin's price action in Q1. BTC's price is always the biggest story in crypto, and for good reason. Just listen to this, and I quote, Bitcoin outperformed all major asset classes with a plus 69% return in 2024 Q1. Now, isn't that just a beautiful sentence? Music to our ears. Anyway, on the topic of other major asset classes, let's just say that CoinGecko is generous to our coinless counterparts. The report acknowledges that, and I quote, crude oil, S&P 500, NASDAQ, and gold also saw strong gains in Q1. But they mean strong by TradFi standards. So let's see how these assets did compare to BTC. After dumping by 21% last quarter, crude oil made a 16% recovery in Q1, giving it the best returns among major TradFi assets this year. In second place, the S&P 500 continued its face-warming rally, gaining 11% in Q1. NASDAQ and gold were next, printing gains of 10 and 8% respectively. And then there's BTC, up 69% in Q1, after rallying 57% in Q4 2023. Well, each to their own, I guess. But of course, it wasn't up only for BTC last quarter. After the long-awaited approval of the US spot ETFs on the 10th of January, BTC dumped by 16% to its Q1 low of $39,505. With a major catalyst seemingly over, it looked for a time like the ETFs were an anticlimactic sell the news event. After all, they were already priced in, and we were already up way too much after that 57% rally in Q4 2023, right? Wrong. BTC bounced up 85% from the January low and moon past the previous all-time high of $69,000 set in 2021 to a new set record of above $73,000 on the 14th of March. This was particularly remarkable because it was the first time BTC reached a new all-time high before an upcoming halving, rather than sometime afterwards. By the way, if you're enjoying the video so far, smash the like button to give it a boost. And while you're at it, make sure to subscribe and have your bell notifications switched on so you can catch our next video before the rest of the pack.
So, ma'am, where exactly were you on the night of the murder?
I was right here, Detective, all night long.
You got anyone who can back that up?
You mean an alibi?
Yeah, that's the one.
No, I was all on my lonesome.
And what exactly were you doing all on your lonesome, if you don't mind me asking?
Well, keep it under your hat, Detective, but I was looking through the Coin Bureau Deals page.
What's a Coin Bureau Deals page when it's at home?
It's only the place where you'll find the best discounts and promos in all of crypto.
What do you mean?
I mean, trading fee discounts of up to 60% and sign-up bonuses of up to $60,000 on some of the best exchanges.
Holy smokes! They got discounts on hardware wallets too, by any chance?
They sure do, Detective, like you wouldn't believe.
Well, that sure sounds kind of swell, lady, but just you give me one good reason why I should believe a single word you say.
You don't have to take my word for it, Detective. Take a look at the link down below and see for yourself.
She wasn't kidding. Those deals really were something else. Turns out that crypto ain't such a bad place after all. You just gotta know your way around.
Now, the pre-halving all-time high fueled all kinds of speculation about how long the current bullish conditions can continue, and if the market can catch us all with our trousers down by topping out sometime this year. That's another topic for another video, maybe even on another channel, but this much at least is clear. Q1 was a dreadful time to be bearish on Bitcoin. But it's not just the bears who have to cope. If you were bullish on altcoins in Q1, well, I hope you took some profits at the right moment. That's because the overall crypto market underperformed BTC. As CoinGecko reports, the total crypto market rallied by 64.5% in Q1. That's a fantastic return in general, almost 6 times better than the S&P 500. However, it's notably weaker than BTC's 68.8% rally. And what are the altcoins if not a leverage bet on Bitcoin? You can take on more risk in the hope that you'll get higher returns than with BTC. But for your average altcoin investor, all of the hours of research, painstaking portfolio management, and risk-taking in the world couldn't outdo just buying and holding BTC. Of course, if you bought and sold into the right altcoins in the right narratives at the right time, sure, you outperformed and perhaps by a lot. Well, congratulations if that was you. But this is much easier said than done, and the charts don't lie. Most people did not do this, and therefore would have been better off just stacking sats the whole time. As a friend of the Bureau, Ben Cowan is so fond of reminding us, BTC gives you the best of the crypto market's upside while minimizing your downside risk. This was confirmed yet again by the market correction on April 2024, which saw BTC pull back by at worst around 18% before chopping around between 60 and 70k. Meanwhile, the same correction has wrecked altcoins so badly that degens are complaining that this month's Bitcoin halving seemed to have also halved their net worth. When altcoin season indeed. Now, no discussion of crypto in Q1 2024 would be complete without a proper look at the US spot Bitcoin ETFs, and CoinGecko provides us with ample data to see just how well they performed. When the ETFs were approved by the SEC on the 10th of January, the sum of their total assets under management was $28.6 billion. This sum was almost wholly managed by Grayscale, whose decade-old Grayscale Bitcoin Trust was converted in its entirety to the GBTC ETF. This was a huge head start over the competition, who started from scratch. So it should come as no surprise that several months after the launch of the ETFs, Grayscale still holds the largest slice of the total AUM. However, what is remarkable is just how quickly Grayscale has been losing ground, especially to BlackRock. By the start of April, the AUM of all of the ETFs had almost doubled, rising to $55.1 billion. This increase was mostly driven by BlackRock's IBIT ETF, which mooned all the way to 17 billion AUM, no doubt helped by having lower fees than the competition. Meanwhile, the AUM of Grayscale's GBTC dropped by $7 billion, or almost 25% during the same period. This makes it the only ETF to have seen net outflows in Q1. It doesn't help that GBTC has significantly higher fees than its competitors, but we should also remember that GBTC predates every other ETF. This means that right out of the gates in January, there were GBTC holders in profit who were ready to sell, and perhaps to rotate into an alternative with lower fees. In response to this, it appears that Grayscale is preparing to launch another spot Bitcoin ETF, this time with an aggressively low fee of 0.15%. If all else remains equal, this new Grayscale ETF will have the lowest fees on the market after BlackRock's scheduled fee increase to 0.25% next year. The next section of CoinGecko's report covers the performance of Ethereum and Solana in Q1 2024. It's been a heck of a ride on both chains this year. Let's start with Ethereum. One of the biggest narratives on Ethereum this year has been ETH restaking on EigenLayer, which grew by 36% in Q1, bringing the total amount of ETH restaked to 4.3 million. In particular, this year has been characterized by the advent of liquid restaking protocols. At the start of the year, EigenLayer was the only show in town and accounted for basically all restaked ETH. This was referred to as natively restaked ETH, but by the end of March, more than half of all restaked ETH was not natively restaked, but instead held in liquid restaking protocols. This new sector has yet to be monopolized in the same way that Lido came to dominate liquid staking. But EtherFi does have a convincing lead, commanding a 21% market share with 910,000 ETH. Renzo and Puffer are in second, and we'll have to wait and see to find out if any of these is ultimately going to pull a Lido and steamroll the competition. Next up, we finally saw Ethereum Improvement Protocol 4844, better known as the Dencun upgrade. This went live on the 13th of March and was, by all accounts, a great success. It introduced blobs and proto-dank sharding for the first time, and if you're not sure what all of this means, then you can hit pause and get caught up with our video explaining the Dencun upgrade. The link is down in the description. The short version is that fees on Layer 2 networks like Base, Arbitrum, and Optimism have been reduced by a factor of 10 to 100x. At the same time, Dencun increased scalability or transaction speed of Ethereum Layer 2s by a factor of 45 to 100x. Of course, what we all really want is to lower the fees on Ethereum mainnet, but Dencun was a major milestone on our long journey to get there. And of course, we have the performance of ETH, which rallied 59.9% in Q1 and briefly broke above $4,000. Again, this is an excellent return in general, but it's also yet another quarter of ETH underperforming BTC. Speaking of, we've seen people calling the ETH BTC bottom for months on end now. So is the bottom finally in, or are ETH maxis in for more pain? CoinGecko's report doesn't speculate about this, but it's certainly something to keep an eye on in Q2. No prizes for guessing which large cap did outperform BTC though. Sol continued the monster run it began in late 2023 and closed Q1 at $202.8 for a quarterly return of 100%. Not even a 5-hour network outage in February or debilitating network congestion in March could hold back Sol. As CoinGecko points out, average daily traded volume almost doubled from $2 billion in Q4 2023 to $3.8 billion in Q1 2024. Aside from the price of Sol, the biggest story on Solana was, of course, the meme coin mania. CoinGecko's report lays bare the true extent of degeneracy that took place last quarter, and it is mind-boggling. There was almost 5,000 new tokens launched on Solana every day in Q1 2024, and let's just say that most of them had questionable fundamentals. Of the top 10 memes on Solana at the end of Q1, only 2 were more than 6 months old. In Q1 alone, this shiny new top 10 rallied by 800%, growing from a collective market cap of $1 billion to $9.36 billion. Looking at CoinGecko's chart, it is crystal clear which memes we all should have bet on. WIF went absolutely nuts with a parabolic rally in March that saw it close Q1 with a market cap of $4.6 billion. This accounts for almost 50% of the market cap of Solana's top 10 memes, so it looks like the hat is staying on for the moment. Next up, DeFi. CoinGecko represents this category with a list of the top 100 DeFi-related tokens by market cap. Of course, this is just a fraction of the DeFi tokens out there, not all of which are even tracked on CoinGecko. It's also a bit of a nebulous category. For example, at the time of making this video, Lido Staked ETH accounts for a third of the DeFi sector's total market cap. But at the same time, CoinGecko doesn't include liquid restaking tokens like AETH, AZETH, and RSETH in the category. So, are we saying that liquid staking is DeFi, but liquid restaking isn't? Perhaps we're nitpicking, but the point is that this category isn't quite as clear-cut as, let's say, meme coins or the Solana ecosystem. So, a pinch of salt may be in order when looking at the DeFi statistics here. At any rate, the total market cap of CoinGecko's DeFi category increased by 49.1% in Q1, so not to be sneezed at. But you know what we're going to say next, right? These cryptos underperformed not only BTC, but also ETH. If DeFi was a narrative that you wanted exposure to last quarter, well, probably the best play would have just been stacking ETH. Now, to get a better sense of development in DeFi, we should pay less attention to the market cap numbers and more to the total value locked across distinct sectors like liquid staking, lending, and bridges. Turning to CoinGecko's TVL analysis, we can see that these sectors occupy the top 3 spots, with approximately 30, 18, and 14% of total DeFi TVL, respectively. We can also see that the overall TVL of DeFi increased by 70% in Q1, but we should be careful about how we interpret this. That's because TVL increase is not just an expression of increased DeFi activity and inflows, but also a function of price appreciation of the assets involved. Case in point, liquid staking TVL rose by 73.7% in Q1 to $56 billion. But if that sounds like a ton of more ETH was staked, well, think again. As the report points out, this increase was mostly just off the back of ETH's 60% rally in Q1, and the amount of ETH staked actually increased by just 10.7%. Other highlights from the quarter include the restaking sector, pulling almost 11x to $12.6 billion. Also, lending and collateralized debt positions protocols TVLs faded as the bull market made the sector's returns appear less attractive. CoinGecko identifies yield, derivatives, and farming protocols as beneficiaries of this change, pointing out the TVL of these sectors doubled in Q1. It's worth pointing out, though, that this trio still accounts for under 6% of the total DeFi TVL, while lending and CDP take up almost 24%. The final section of CoinGecko's report reviews activity on centralized and decentralized crypto exchanges in Q1. While we're on the topic, if you want to buy or trade crypto on centralized exchanges, be sure to go to the Coin Bureau deals page first. There, you'll find trading fee discounts of up to 60% and sign-up bonuses of up to $60,000 on the best exchanges, exclusively for our subscribers. These deals are available for a limited time only though, so catch them while you can. Now back to the report. Beginning with spot traded volume on the top 10 centralized exchanges. You'll first notice that Binance is still top dog by a very wide margin and has reclaimed some of the market share that it lost in 2023. It bounced from lows of around 40% last November back to almost 50% by the end of Q1. This was no doubt thanks to the conclusion of the regulatory FUD that hung over Binance last year, with CZ stepping down as CEO and accepting a plea deal with the US Department of Justice in November. This graph also tells us the story of last quarter's bullish market conditions. Firstly, the cumulative spot volume of Q1 was almost double that of the previous quarter, and at 4.29 trillion was the highest quarterly volume recorded since December 2021. Secondly, March 2024 saw more traded volume than January and February combined, no doubt related to BTC making new all-time highs for the first time since 2021. Lastly, we can see that MEXC shares of traded volume has been in decline since Q3 2023, shrinking from around 6% in October to just 2.6% in March. This is remarkable considering that the global spot traded volume increased by 460% in the same period. So what can we learn from this? Well, if you're familiar with MEXC, you'll know that it's very active when it comes to listing new small cap cryptos. MEXC may not have the same blue chip reputation of the likes of Binance or Coinbase, yet it occupies a very important niche, giving on-chain coins the accessibility and traction that they need to get listed on bigger centralized exchanges. We can work out from this shrinking volume that wherever we are in this cycle, it's clearly not the late-stage euphoria where profits from BTC and large cap cryptos are being rotated into even riskier small cap cryptos, as seen in previous cycles. In fact, the opposite seems to be happening, with attention and liquidity being absorbed by BTC and large cap alts, memes included. Last but not least, CoinGecko shows us spot traded volume on decentralized exchanges broken down by chain. Now, here is an interesting graph. You'll notice right away the sudden expansion and contraction of the blue band in January and February. That's Arbitrum's short-term incentive program, which allocated up to 50 million ARB tokens to projects building on Arbitrum in an attempt to incentivize network activity. True to its name, this program saw Arbitrum suddenly and briefly become the biggest chain for spot trading, grabbing almost 40% of all DEX volume before plummeting to just 8% in March, significantly below the low of 13.5% that is set in October 2023, when on-chain was basically a ghost town. Folks, if there's one thing we can learn from Q1, it's that the rotation between narratives has been absolutely cutthroat. We're still very much in a PvP mode, especially on decentralized exchanges. Now turning to Ethereum. In share of DEX traded volume, it appears to be in a medium long-term decline, falling from 56% at the start of Q3 2023 to the low of 30% by mid-Q1. This was certainly exaggerated by all of the activity going to Arbitrum, which, for what it's worth, is an Ethereum layer 2. The Ethereum mainnet closed Q1 with 37% of DEX spot traded volume. But we'll have to wait and see to find out if it's going to break the overall downtrend. The other biggest story was, of course, Solana, whose share of volume grew from 8.6% to 21.3% in Q1, buoyed by memes and airdrop hunters. We saw the same thing happen on Base, albeit by a much smaller scale. Its share of volume grew from 0.4% to 2.38%. When we zoom out and look at the global spot DEX traded volume, we can see that it's more than doubled from $87 billion in January to $190 billion in March. Again, no doubt helped by Bitcoin's new all-time high there. It'll be really interesting to see from the data April though, because as we mentioned earlier, this month's market correction totally wiped out months of gains for many on-chain coins and caused gas fees on the Ethereum mainnet to plummet to their lowest level in months. So that's all very interesting, but what's the TLDR? And what can we expect in Q2? In Q1, Bitcoin reminded us why it's the main character in this show. The flywheel of ETF inflows, the bullish price action, and media hype resulted in an unprecedented pre-halving all-time high. BTC has since cooled off with a retracement, followed by choppy price action in April. Market sentiment is now somewhere between bored and downright gloomy, and this has left us at a crossroads. Bitcoin will eventually break out of its current range, and then we're either going to go up or down. It's impossible to say with certainty which it'll be, and that's why we have to be prepared for either outcome. If BTC sees a larger correction in Q2, it's likely going to be very ugly for altcoins indeed, as Bitcoin's very normal retracement in April already nuked many of their charts beyond recognition. At the same time, you'll start to hear the word healthy a lot, and perhaps for good reason. Based on the current market sentiment, you wouldn't know it, but the crypto total market cap is still up a lot. The market became extremely hot in Q1, and cooling off in Q2 would most likely give us more room to run higher in the next 12 to 18 months. Conversely, if BTC starts to run hard again in Q2, altcoins will inevitably benefit, and no doubt many of us will be very happy. But at the same time, such a move would lend credence to the argument that a cycle top is coming faster than most of us are expecting. In this case, it would be a good idea to review your exit strategy so you don't end up round-tripping your bull market gains. Ultimately, only time will tell which way we're going. So, in the meantime, keep your bell notifications on and the subscribe button thoroughly smashed. That way you'll be able to catch up with our next market update video. Right, that's all for today, folks. A big thank you to everyone at CoinGecko for this excellent report, and happy 10th birthday again. If you learned something new, don't forget to drop us a like so people can see the video. If you think we missed an important development from Q1, let us know about it in the comments. As always, thank you so much for watching, and I'll see you all next time. This is Jessica, over and out.